Right, you've been very patient. So let me get straight into this. You're not in to see my screen yet, so let's quickly share screen. Brilliant. Okay, so what I'm going to do is I am going to go through a very short presentation. I'm going to talk about exactly what I've done in 2022, and then I'm going to outline what I'm looking for in 23. And so at any stage, punch in a question in the text box. And then if you would like to ask a question, physically ask a question, then I can turn on your mic, etc. But in the meantime, let's get straight into this and let's come out of these slides as quick as possible and get into the nuts and bolts of what I'm looking for in 2023 and this recession that is going to hit. Right, I've been trading stocks and commodities for over 40 years. So what I mean, I'm heavily into reading the cycles, and this has been my real edge, my strength in the marketplace, because I sold 80% of my portfolio 2 hours before the September 87 trade figures came out, and 3 days later the markets popped. I'm not in the business of predicting tops and bottoms. I'm in the business of making money, and I'm in the business of exploiting the best in the markets. During the 07-08 crisis, I was buying gold in US denominated ETF accounts. So why is that relevant? Because it's relevant because the dollar was shooting up as well as gold. So we had such fear in the markets. Dollar and gold are safe havens. So in the 07-08 crisis, one way to tackle, one way to exploit and come out on top of that recession, or that crisis, was to exploit gold. At that time, we were into a commodity boom as well. So I was exploiting, in the run-up to that recession, I was exploiting oil predominantly, and then concentrate on gold once that became relevant. There's also you don't have to even trade gold. There are different ways that you can get into gold, and we'll talk about that. If there's time, we'll talk about that. Right, so I think the second main thing is trust the charts, especially volume. Volume is the lifeblood of the markets. Anybody who splatters a whole lot of indicators over their charts, assuming we've got all technical traders in the room here, anybody who puts a lot of technical indicators on their charts is unlikely to actually be able to read and see what's going on. So as far as I'm concerned, if you know how to interpret volume and you know how to read the charts and trust the charts, then you can make money. Ignore the noise. I kept getting an email in the last 6 to 12 months, and this particular email was titled, the recession newsletter. Well, that's great, but it's if you get to thinking that the whole thing is all about the recession, then you're going to miss out. Some fantastic, believe it or not, one of the things I'm here to talk about is when you should be timing your re-entry into these markets. I do trade currencies, and in actual fact, one of the first things I'm going to talk about is currencies. Yeah, hang on, and we'll get on to that. So what did I do in 2022? Well, it was dominated by this aggressive rate cycle, by this incredible leap in inflation. And it wasn't just about the war, it's about the commodity super cycle we're in. The war was like the perfect storm as far as commodities are concerned, because the super cycle was already underway. The war just accelerated it. Ukraine is the wheat basket of Europe, so I'm going to be talking about specific commodities as well. I love commodity trading. I think to some extent, 2022, if you really wanted to maximize profits in 2022, then if you just focused on commodities, you should have done really, really well. So I'm going to spend some time on commodities and talking about those. So when the recession hits next year, really hits, then central banks could take rates back by at least 200 pips. So, for example, projection in the US, we've got 4.5% in the US at the moment. The projection is that the consensus, I should say, is that US are going to get up to 5.25%, and the UK will follow with those kinds of leaps, another 125 pips in the UK. If that happens, if we get the predicted recession, I think the aggressive rate cycle will reverse pretty quick, at which point that could trigger the turnaround of the markets. More on that in a minute. Right, let's just spend a little bit of time. I'm very nearly through these slides, so if you're getting bored with slides, don't panic, because I'm not going to spend much more time on them. Right, this is UK forecasting. We have had 1.9% this year, and we're looking for a drastic slowing where are we? So we're looking for a negative number in Q1, -1.5, and as we get into the autumn next year, -2.1, with an inflation rate still holding up into the first quarter, and in actual fact still holding up through the first 6 months basically, and only in the second half of the year tailing off. And I would go along with that. That's my sort of feeling as well, given the charts, but I'll come on to those in a minute. Okay, so this was actually higher than expected, that 1.9, hence the reason why the FTSE has held up so well. Yeah, I'll come on to that in a second. So I think, okay, I'll just stick to this at the moment. Let's go through another chart, and then I can I'll start answering those questions. Right, so here's the US. Now, we've had growth rates of GDP 1.9, but they're still looking to hang on to their growth under 1%, but then into 1.1, and then just under the 1% into the back end of the year. If this is wrong, what I'm suggesting is if that comes in lower and then actually declines, becomes a negative number, then I think these rates we've got could come off the boil, and we could see, so these projections are based on 5.25% rates in the US. These forecasts are from a website called tradingeconomics.com, but they're sourced from the central data. In other words, they are qualified from state data, not academic projections. Okay, so a couple more slides, and then we're going to get into the real stuff. So if we've topped, which the market suggests to say we have. So in the early bear market, we've had healthcare and non-cyclicals, in other words, non-consumables. We've got things like utilities have been doing well. So these are safe havens. So healthcare and utilities are the safe havens. And you can see from your own charts that the money has been coming into these safe havens. So if the recession is relatively short, bear in mind, we've had pretty much an 11-month bear market in the US up till now. So most bear cycles are normally about 18 months. and that's a typical period from recessions going back to the 1970s and 80s. Okay, they're normally only 18 months. If we're 11 months into US bear market, then it would figure that into the second half of next year, we could be coming out of this. So one of the things that's in my priority is to be very, very clear about where we are in the stock market cycle, so that I know when to, so I know when to stop being bearish and start getting my capital back in the markets. All right, so if we got 6 months down the line, then we need to come out of this side and then come into this side. And particularly my priority is going to be coming back into technology. As you probably know only too well, the US technology side has been predicting certainly an earnings recession. So the recession that we are coming into is going to be an earnings recession, unlike the crisis that we had 07-08, which was a ridiculously stupid recession that could have been avoided had Greenspan not deregulated the US market to such an extent. Anyway, that's another story, so I'm getting distracted already. So that's what I'm looking at. So if I'm right about the second half of 23, contrary to the title of this session, I'm going to be looking to invest. I'm not going to get hung up on the recession. If the market tells me that the money is coming back in the markets, then that's where I want to be. All right, so this year I was buying some stocks, particularly in value stocks. I adopted a value strategy, come right away from the growth strategy that I used in the prior year. So I was investing in telecoms, a couple of chip companies, miners, sold them into the first rally we had in 22, and now I've been dumping them into this rally that we're just completing into the back end of 22. So throughout the year, I day traded gold, oil, and indices. So my typical day would be at the screen between 2:15 and about 4 o'clock, as I was day trading these markets. And one of the main reasons for being a day trader is hedging. If I've got value stocks in these sectors, then I can hedge. If some of them are dipping, or even potentially coming up, making me go underwater, I can hedge and still profit. So that's one of the reasons why I enjoy being a day trader so much, because it's an income source and it allows me to manage the risk in my investments, my swing trades. And I was in on that $1,620 we saw on the gold. Took 3 months to base on the gold, and I'll show you what I was looking at in the gold in the autumn. And of course, oil has been a fantastic trade. Oil is a very, very technical market, so I love oil very much. And of course, indices are the best way to hedge. Right. Moving on. Don't worry if you missed this, because it's all on YouTube. So if you miss the start or you miss the whole thing, then you can catch up. Right. So coming back on what I've talked about in a couple of other slides, I expect the rate cycle to go into reverse in the second or probably the third quarter of next year. Inflation is very stubborn. I am expecting the commodity super cycle to pick up, and that's going to hold inflation up. But once those negative growth levels come in, particularly in the UK, then I think we could see the end of this aggressive rate cycle. Okay, I think the UK will lag by potentially 3 months. So short term, I have been talking about bear raiding over the last 18 months or more. Well, if you go way back, I started talking about bear raiding bricks and mortar back in about 2014, 2015. It's a pity my spelling is not great, but I'm looking to exploit resistance levels in these indices as we get the new year underway. But as you probably gather by now, I'm very, very interested in commodities, particularly silver. Why silver? Because it's used in car batteries and solar panels, as well as medical instruments. So it's got a good industrial use, unlike gold, that does not have a significant industrial use at all. And I think the grains have been a perfect, really good trade this year, and I expect them to be even better next year. Right, so let's talk about let's go back to these charts then. Let me show you what I'm looking for. Right, I'm going to start off with the dollar. I said I would talk about currencies. So I'm only going to talk about the dollar and the pound. I'm not going to go into some of the other majors or even the minors. If this dollar continues to drop in the first part of the year, it loses this aggressive trend it had in 2022. So these vertical lines are the 2022 range. If this dollar sits on this support and continues from here, then I would expect the markets overall to decline. So this end of year rally, the Christmas rally that we've seen in the US particularly, is very common, but it's come on the back of a weak dollar. So like I said, if this turns around, if this support holds, then hold on to your hats, because we're going to see some selling into the first weeks and months of the year. If we flatline or come underneath and then drop back into 22 ranges, then that supports higher equity markets. So whichever way this goes from this point, I think is a market proxy. I'm going to be using this as one of my many market proxies to determine whether I think this market can pick up or not. All right, so as we come into as we've seen a nice move from September, October, the dollar's come off on the back of that. If sideline go lower, then I think that can sustain the markets. If this holds and goes back up, then watch out. So a quick look at the pound. I've got a lot to get through, and I don't want to take up too much of your time. When we get back to festivities. Right, so here's the pound at this 120 mark. So we've got a potential head and shoulders here. Shoulder, head, shoulder. So again, as you expect me to say, if this drops underneath here, then we look as if we can come back to these lows, and the equity markets might come off. If we go sideways, then the markets are potentially going to go sideways. If this accelerates, then the American market in particular should benefit from that. Okay, so we saw a really key breakdown here very early on in the year, this year. We saw a decent 5-wave pattern. We've got a 3-wave corrective pattern here. So whichever way, once the correction is probably over and done now. And so once you've completed a 5 and 3 wave pattern, then you're basically at base point. Hence this deep red line. This deep red line is the base point. So if we go sideways, then expect chop and sideways in the equity markets. If we break down, then that shows we've got money fleeing into the dollar, and equity markets could come down. Right. Let's look at silver. Let's start by looking at commodities, because I think these commodities are really, really important. This is a weekly chart, by the way. All these charts I'm showing you are weekly, just to try and get my head around the bigger picture. Now, you've noticed that I've only got volume on this chart because, as I said before, volume is the lifeblood of the markets. And I do like MACD. You can also, MACD is great for divergence, in other words, reversals. And RSI, you can even pick up, if you know how to read the RSI properly, you can even pick up divergence in the RSI. So I do look at MACD, but when I'm just looking at the bigger picture, the bigger time frame, I just want to get a very, very clear grasp of what the pattern is telling me, the chart pattern, and I want that to be supported by volume. So in the silver market, I think I'm very bullish these silver in particular. We've had a very nice move off of I think right down here, probably about 17.5, I think. So we've come into a trend line resistance here. So I'm expecting it to take a breather, particularly if the dollar picks up in the first part of the year. Any push back to 20 is definitely viable. And I think if we see weakness in the first part of the year, I can see this industrial precious metal pulling right back as far as the 20 mark, and maybe even boomeranging right back to 18.5. That would be a gift if we come back that far. In the meantime, you could still buy, shallower pullbacks. If you want further guidance on possible ways of trading these in terms of the instruments you can use, for example, you've got funds, you've got ETFs, exchange traded funds, you've got investment funds, and you've got anything from spread betting, the actual commodity itself, and even the futures market. And if some of you are really clued up, you might even use the options market. All right, so very nice three-wave push into resistance. The very least, I think we'll see 21, 22. It may be a deeper pullback. So I would not chase this market. What I wouldn't do is, if you don't have any exposure to silver, I wouldn't suddenly start diving into it, because I think you'll be buying high. We've just got to hope that this will knock against this resistance and drop before this really takes off. If you look at this part of the chart, you'll see how all this significant volume came in here, and we didn't pull back until after it gone to 30 up there in 2020. So we got a shallow pullback into about 22, and then we went back to the highs. So it is possible that, I'm suggesting to you, don't buy the highs. Well, it is possible if we close up here, then the pullback to that trend is going to be it. That's the only pullback you're going to get. That is one scenario. And then we could just grind up and potentially. So my target is 35. I think we're going to get 35 and potentially up to 50. Potentially. So all I can say at this stage is we're at resistance. Let's hope we get some dollar strength to drag that back. What does volume show? Good question. Volume shows commitment from the market. It shows it's the market showing its hand. If you are coming up on volume, on an increase in volume, then you know you've got the support of the market. If you are coming down on increased volume here, then you know you got weakness. So at the what's volume telling you at the moment? Volume is telling me that this move was well supported, so there was a decent bear following, but there was a splattering of red in that, unlike this level here. You have to. I haven't got time to go into specifics about that, but it's a good guide. But these are actual trades firing off, yeah. So if we, okay, so here's the scenario. If we close up here and this volume ticks higher, then you know the chance, it is possible we may not get the pullback that we want. If we come into the year and that bar is up there showing a breakout in the volume and a breakout in the price. If you look at gold is again, this is a weekly chart. The shallow pullback will be 1726. If we don't pull back, the volumes are increasing here. We are seeing higher volumes from this September-October breakup. Next stop is 1850. So once the move is underway, it's hard. Are we still in wave 3 here, and this can extend up to 1850, or are we running out of steam and we're going to get a wave 4 back into 1725? That's the tough side of trading. I do not know the answer to that. Again, I refer you to what happened in June 2020. Again, I've pinched the screen up deliberately so you can see the effect of the volume here. You can see how the volume increased as we were building here, and then it just flew into 2070 up there into the second half of 2020. One thing to note, when we came back up here, this is a good explanation of volume. Once we came back up, we were just shy of that high, but we came up on look at how that volume accelerated there. It didn't accelerate in quite the same way. It wasn't as consistently high here. So it shows it didn't have the commitment. And once we start to drop off here, the selling volume accelerates. You get a breakup in the selling volume. So you can see why that came back down so far. We have come up on weaker volume, so I'd be very surprised if we don't peel back to that 1720, 1725 based on what we're seeing on volume alone. So if we can pull back to that level and hold, then we've potentially got a 1, 2, 3, 4, 5, 1, 2, 3 wave correction. And then as we get into the second half of the year, if we get that kind of pattern, then we could break out in the same way as we broke out here. Okay, so what the word of caution, these are not, I'm not suggesting for 1 minute you dive into these. I'm suggesting that you need some careful guidance as to where these markets are and where they might be going. I've not looked at Bitcoin. Actually, I didn't even think about looking at Bitcoin. Autumn last year, I did a post and videos about how I thought this was coming back to these levels. And the main reason why I projected these would drop is because they had gaps down here. So I predicted these would gap fill. And it has done. So that's a very nice. And look at the volume. Look how this Bitcoin has come down on an increase in volume. It came up. It's worth just chewing over this for another minute, because if you look at the way in which the volume came here, saw more volume here, and then the volume started to decline as that fell back. You got a three-way push up there with some more red on the charts. It didn't reach quite the heights that the volume had before, and then we saw this fall off. And the volumes are still pathetic down there. So I think we could see 10,000 on the Bitcoin. Anybody trade Bitcoin here? Anybody interested in Bitcoin? Don't get me wrong. I think these crypto coins are fantastic, and they definitely, I believe they have a future. I just don't believe they bottomed out yet. My fear and the huge drawback of these Bitcoins is, how can you have a global currency that is this volatile? Just imagine if the pound was that volatile, or the euro was that volatile. You know, that's I guess we have seen quite a leap up in the dollar, hence the and look what that did to the market. That created quite a nice bearish 2022 bear market. All right, so yeah, well, if you're on the right, if you're trading it on the right side of it, great. Yeah, I was thinking more in practical terms of how Bitcoin could be part of our economy and the global economy. Right, I'm going to switch now on to commodities, because I think this is the one thing that really lights my boat. Wheat in particular. I think this wheat. Okay. Wheat in particular, I think this is potentially already bottoming. I have been engaging this market on these lows, but if we break this $7, then I'm going to sit there and wait for 670 in the early part of the year. And but if I would love to see this come down to 650, 670, at which point I would be taking significant positions. I'll be using the maximum I'm allowed to in my trade plan to get in on those on this wheat. And that goes for corn. Corn's already sitting up higher, and soybeans. So, but okay, we've obviously got some Bitcoin fans in, but if one of the things I would, even if you are a Bitcoin fan and you've not traded commodities, I would suggest that you should still at the very least consider these commodities, because if these commodities can move at this kind of rate while the Bitcoin is flat and potentially lower, and this is another way, this is a good way of putting your cash to work, putting your capital to work. Because if I'm right about these soft commodities and they start breaking up again, then I think this soybean, for example, could I'm expecting this soybean to go up to 22, 25. If we come back, if at any time soon we come back and sit above this 1820, then this is going to blow up. If you look at how this blew up in the first place, we saw this accumulation pattern down here, and then we've got a huge impulsive wave, a pullback into 50%, a return to those highs. Now, if we are, so if this is going to break up again, we need this area here to hold. We need to start closing above 15, and then I think we can go to 22 plus. Okay, so I am waiting for 2023 to get underway, but these pullback areas, I'd love to see 13. Well, I don't think we'll see 12.25. If we do, I'll be all over that. I wouldn't be surprised to see 13.30 in these beams. However, if they don't pull back and we sustain this level here, I will get in higher. Right, let's look at natural gas. Natural gas is falling right back into this support. I'd love to see it fall back into this area here. This is absolutely typical of natural gas. I started talking about how I like cycles. Well, this is very, very typical of a natural gas cycle. You tend to see the highs in November, and it doesn't tend to pop up unless you get a very, very cold winter. I know the US is suffering right now, so it's possible this may bottom here and pull up. And again, you don't have to use a lot of leverage for markets like this. You could go into conservative ETFs and funds rather than get into some heavy exposure. And of course, risk management has got to be at the front of everything you do. 77% of retail traders in the IG index company lose money. And the main reason why that 77% of those retail traders lose money, one of the key reasons is they don't understand risk management. So that's something I will be coming back on and talking about in more detail very soon. All right, now let's have a quick look at oil. I think oil is already looking like it wants to pop back up to 9,800 here. As I've said earlier on in previous slides, I day trade oil. I have exposure to oil, and I'm looking for this. All we've done is we've boomeranged back to December 21. And look what happened in 21 into even before the war was declared. This oil was already climbing up to some very, very aggressive levels up there. So even before the new year is coming up, is up and running, we are back, we've boomeranged back to the area in which this broke out from. So that's a very, very bullish area. It produced a huge move last time. It may not produce the same level, but I do feel it's got the potential to at least go back to 100. If I'm wrong, I'm happy to be proved wrong. If we start closing up, if we can't sustain 80, 85 plus, 80, 50 plus, and we start closing underneath here, then that likelihood that oil could come back there is off the table, and I wouldn't get back into it until it sat above this 82. Commodities love these big numbers, so we're literally just 45 pips above the big 80 here. So we need to absolute minimum hold the 80 if we're to have any chance of going back to these highs. But I believe that at least part of this pattern we saw December last year will be repeated as we finish December this year and go into the new year. Oil is a very relatively thinly traded commodity, hence the reason why there's not millions of people buying many thousands of barrels of oil, hence the reason why the volumes is a little harder to detect in that one. All right, so let's move on now to stocks, because all I'm here to do is to give you a little flavor of what I'm doing. So I'm just not going to spend that much longer on this because I personally want to get back to festive celebrations. Right, just going to talk about miners. Now this particular miner I am in this still, buying these lows. We've seen 22, 23 up there this year, but at the moment we are declining. We have seen some increase in volume in November, but there's a lot of lower close on this weekly chart. Now, it looks as if this is Pan-African, PAF. It's a small cheapy stock. It looks as if we could be coming down to 14, 15p here. We're underneath this price structure. The volume is not being sustained. The weekly chart is closing lower. So at the moment, now either we are just going to sit back into this 15p and hold, or if we close on the 15p, then expect significantly lower. So my stop is underneath these levels here. I will jump out if that starts to give way and step aside. If, however, if we have a good start to the year and start closing above 17, 18, I will increase my position on pullbacks and look to see. Ultimately, I'm looking for this to go back to 25 and 30. Let's look at some other ones. That Rothschild is not a stock I would suggest at the moment. Griffin. Yeah, so a lot of all these miners are suffering the same fate, apart from this sentiment is doing extremely well. It's coming up on steady volume. Okay, right. So what I'm going to do is I just want to finish. So so just to recap then, in terms of stocks, I have been bear rating stocks. I'll show you a couple of in bear rating. I have been bear rating this one, Card Factory. Card Factory was at 95 in May last year. I did short 65, 66 here, took it off at the 40 mark. And this is coming right back into the big drop zone so I'm getting interested in this one again. It's come up on low volume. So I am contemplating selling this. So this is the kind of strategies I'm going to be talking about in great detail right now. If you want to be in on this, the Millennial Wealth Club is kicking off 1st of January. The Wealth Club gives you the option of mentorships and a live training room for day trading, but the whole guts, the whole main feature of the Wealth Club is bi-weekly webinars with trading ideas to do with these markets that I'm looking at. So yeah, I'll come on to that. Good question. I'll come on to that in a second. I'll finish up on that point. So if you want to have access to in-depth analysis and charting and predictions for the weeks and months ahead, then this Wealth Club is £57 a month, which includes 2 sessions a week, educational webinars, discounts on conferences and mentorships. Now, if you subscribe for this and you get 2 weeks into it and you think it's not for you, you will have a no questions asked full refund, but you're going to have to tell me within the first couple of weeks. Okay, now if you want to find out some more information on that, these are my contact details, and this is also the free Telegram room. WhatsApp, use the mobile number on WhatsApp for messaging me. Otherwise you can email me or whatever. Right, so there's going to be much more information about this millennial service as the days unfold, but I'm just going to finish on Sol's question about the S&Ps. Yeah, I would hope that we get a lift into the early new year. I think we may get up to 4,200 or 4,300. So the main, I think if we close underneath 3,800, then the obvious, then you know what I'm going to say, you know, get short, stay short. I am hoping we're going to get a further recovery on the back of this initial impulse into 4,100. So the areas I'm looking to short would be 42, 4,300 to get significantly short. Otherwise, I would just going to wait for this to get in and get the year started and to see where we are. I have been buying these pullbacks, incidentally, and all the time we're in this apex. I think the crucial aspect of this chart is this level, these levels here. We've got fib levels, we've got trend lines, trend line high, trend line support underneath. So whichever way we come out of this apex, I believe we can see some upside. You'll notice, based on what I've been talking about on volume, on the volume suggests that we could even just lose our footing here. Yeah, we're going sideways to lower on an increase in selling volume. So the path of least resistance as we speak right now, based on this weekly chart, the path of least resistance is lower. However, like I said, I'm waiting for at least a week or two to get underway. And I think we could get some follow through from this October bounce. But I'm happy to just sit back and let that chart tell me what it wants to do. Note how we kicked off the first week in January with a sell signal. We had a new high in this range and we immediately closed lower right in the first week. So if the first week of this year closes underneath that 37.50, then I will short any pullbacks and look for these levels to come into play. So in the first 3 to 6 months of the year, I think we could see come close to this 3,000 if we do eventually drop from this apex. We could see 2,800 is a post-pandemic support level. And of course, if that gives way, then we're going to retest the 2170. All right. I do have a tighter way of predicting these levels based on the daily chart, but that's going to be part of the Wealth Club. That's going to be one of the essential parts of the Wealth Club. So to sum up, as you can see from the early slides I did on this and the description I gave you of the way in which I handled previous downturns in the economy, in previous crisis like the 07-08, you can see I'm transfixed on cycles, and the position we're in the cycle dominates what I do with stock sectors, and of course dictates what I do in terms of hedging as well. So Now, this Wealth Club is open to everyone. Everyone can benefit from this. I'll be doing educational programs on how less experienced or even beginners can do to get into things like silver and gold and the commodity cycles that I'm seeing. All right. So if you want a copy of these slides, then take that contact detail and drop me a line. That link I've given you is for the Telegram, for the free Telegram alert room. You can message me from Telegram, WhatsApp, or email. Right, any final questions? Thank you for all those questions that have come in while I've been talking, by the way. That's great. That is very good. No, I've got nothing else I want to go through at this stage. I think it's just time. I've been talking for about 50 minutes or so. So unless there's any more questions coming in, I'll be looking out for your emails and requests for slides, etc. And then I will leave it there. This session, I do run a free session every Monday at 6 to look at the markets. The very fact you're in the room means you're registered for that, so you'll get reminder links from Zoom for the 6 o'clock Monday show. But that is going to be just focused on the main trend direction, the dollar, and the main overview of the markets, not specifics. Once the Millennial Wealth Club gets up and running, specifics will be diverted into the fee-paying club. Brilliant. Right, no more questions. Thank you very much for your patience and your questions. I do hope that was useful. I do hope you benefited from that, and watch out for future events and more support. Thank you very much, and have a good time. Happy New Year to you for Monday. Happy New Year to everybody. Thanks a lot, and bye for now.